RBI cuts repo rates, why this is not a solution for reviving investments. What is repo rate? And how does it impact the economy? What is reverse repo rate? How does it affect the economy? What are the key takeaways of RBI's new monetary policy? Would these lower rates revive flagging investments to boost industrial growth? GS Paper 3, Indian Economy. What is the context about? The 6-member Monetary Policy Committee, MPC, headed by RBI Governor decided to lower the policy repo rate by 25 basis points to 6%. RBI has done this after considering the downtrend in consumer inflation, normal monsoon, lower oil prices and smooth rollout of the Goods and Services Tax, GST. What is repo rate? And how does it impact the economy? Repo rate is the rate at which RBI lends money to commercial banks against the pledge of government securities whenever the banks are in need of funds to meet their day-to-day obligations. Higher repo rate may slow down the growth of the economy. If the repo rate is low, then banks can charge lower interest rates on the loans taken by us. What is reverse repo rate? How does it affect the economy? Reverse repo rate is the rate at which the central bank of a country, Reserve Bank of India in case of India, borrows money from commercial banks within the country. It is a monetary policy instrument which can be used to control the money supply in the country. An increase in reverse repo rate means that commercial banks will get more incentives to park their funds with the RBI, thereby decreasing the supply of money in the market. What are the key takeaways of RBI's new monetary policy? It was slumping inflation that allowed the RBI to provide a booster shot to India's economy, which has been growing at its slowest pace in over 2 years. Since it is cheaper for commercial banks to borrow money from the RBI, interest on home, auto and corporate loans are expected to become cheaper as banks should follow RBI's footsteps. The RBI also cut reverse repo rate, the rate at which the central bank borrows money from commercial banks, by 25 basis points to 5.75% from 6%. Would these lower rates revive flagging investments to boost industrial growth? The RBI doesn't think so, as it is hawkish on maintaining price stability. Lower rates are expected to lower the cost of capital and rekindle the so-called animal spirits of entrepreneurs to invest more. The RBI may lower them, but the various banks are in no position to transmit these rates as they are burdened by huge non-performing loan portfolios. Thus, lower rates are not a panacea for reviving investments. If India's industrial growth outlook remains weak, which is the case at the moment, the RBI does have the mandate to boost economic expansion without worsening inflation.